So let's talk about data and what will influence the economy. There are three ways that the Federal Reserve influence the economy in a significant way: the cost of money, the supply of money, and the creation of credit. So let's get into that. Well, the cost of money has increased dramatically. You can see it. This is Fed funds rates, 2-year, 5-year, 7-year, 10-year, 30-year fixed rate mortgage. Just 2 years ago when I was standing here, rates were rock bottom low across that whole thing. A year ago, rates had gone through a big increase, 300 basis points on the Fed funds rate. The 10-year had increased 245 basis points. Then you go to now, and this is the massive increase of further rate increases that have happened. Another 225 basis points on the Fed fund rates, down to 73 more basis points on the 10-year Treasury. That just backed up. That was at 5% just last week. So, but a huge increase in rates. So the cost of money has gone up. The supply of money. Well, we had a massive increase in the supply of money like we've never seen before. You see that in that red box over on the left graph, just straight up 39%. Never in our country's history have they increased the money supply that much. And now it's turning down. You can see it hooked down, and over here, the month M2 money supply year over year is really dropping. We've never seen them take this much money out of the economy this fast. And the liquidity is continuing to be drained. Again, this is the Fed's balance sheet. This was the Fed's balance sheet started in 2007 before the great financial recession. Then you see this big bump up because it was sitting at about a little under $1 trillion. Then it went up to over $2 trillion. Then they continued to jam money during the Obama years. And then President Trump got elected. They started to drain. The economy was doing pretty well. They started to drain. And then the lockdowns happened, and boom, straight up. So they took their balance sheet to $9 trillion. And by the way, what you're looking at, the dark blue is their holdings of treasuries, and the dark red is mortgage-backed securities. So boom, the balance sheet increased. But now you can see it coming down, and they're draining and draining and draining. After that injection, because of those bank failures, once things got stabilized, they're back on taking money out of the system. Now let's talk about the creation of credit. Banks create credit, but a big part of banks creating credit is deposits. And deposits have turned negative. You had one quarter and second quarter of a 0.3. Again, all that money came in. We don't have, it's literally another week or two we would have it for Q3, but I can guarantee you it's going to be a big negative. So we had 4 negative quarters, 1 modest up quarter with that injection by the Fed. And over here you can see the red line. These are the large banks, and the blue line is the smaller banks. Very interesting. Everybody talked about when the crisis came with Silicon Valley and First Republic, everybody pulling their money out of small banks, put it into the big banks. So you saw that spike up with the red graph and the drop down with the dark blue graph, the smaller banks. But in reality, after that happened, the smaller banks are gaining deposits and the big banks are continuing to drain. Part of that reason is a lot of people took their money out, went to the big banks, and realized they get such terrible service and they don't even know who to call and all the rest of saying, this is miserable. I got to get back to my regional or smaller community bank or your business bank like Sunwest. So the big banks have lost a lot. But this ties into credit creation. If the banks don't have the funding to make loans, then creation of credit goes down. And you can see what is happening. This is the tightening of lending standards. Commercial and industrial loans, business loans, have collapsed. The banks have ratcheted down 46%, and commercial real estate's down 68%. It's really hard, as many of you are investors in real estate, to get commercial real estate loans today. Extremely hard. We're one of the only banks out there continuing to lend because we went into it with a fortress balance sheet and we lend in good times and bad times. But we've tightened our standards as well. So this is what's happening with the creation of credit. Now, again, cost of money is going up. It's going to slow the economy. The supply of money is going down. going to slow the economy, and the creation of credit is contracting. I put out a video, and I don't know if any of you saw this, right around Silicon Valley and all the rest, why this will hammer the economy. Think of banks as gas stations. If there's a lot of gas stations and gas prices are cheap, you got a lot of cars and trucks moving around the roads and highways. If all of a sudden the price of gas starts going up, interest rates on money, well, guess what? Less cars are going to be driving. And if all of a sudden a lot of gas stations close or are not providing any gas, then you get a massive slowdown of the cars and trucks moving on the economy. This is why I don't believe at all there's going to be no landing. It will be either a soft or a hard landing.